Yeah.
Greetings from Columbia Business School Executive Education. My name is Lindsay Machala, and I'm here today with Shiva Rajgopal for today's webinar, the C-Suite Playbook for Creating Competitive Value. Before we get into the webinar, I have to go over a few quick logistics with you. As you'll see on the next slide, a copy of the webinar will be sent to you. We are taking some questions at the end, so please prepare that by dropping them in the Q&A box, and we'll get to as many of those as possible. And finally, if you want more information about Columbia Business School Executive Education programs, the best way to do it is to follow us on LinkedIn for the latest programs and insight. It's my pleasure to introduce Shiva Rajgopal. He is the Roy Bernard Kester and T.W. Burns Professor of Accounting and Auditing at Columbia Business School. And he happens to be one of the world's foremost experts on corporate stewardship and strategic decision-making. He's renowned for his groundbreaking research on short-termism and value creation, and he brings deep expertise in governance, financial reporting, and performance measurement. His insights have shaped the thinking of investors and executives and boards, and he's been featured in many, many publications, including the Harvard Business Review, the Wall Street Journal, the Financial Times, and more. So welcome, Shiva. It's great to have you here today.
Thank you. Thank you, Lindsay. Can you see me?
I can't see you. Hold on one second.
Okay.
There you are.
Awesome. Thank you. Wow, it's nice to see so many people. 143. That's a lot. So thanks for spending the half an hour with us. I know you could all be doing something else, so we appreciate the interest. So I've been asked to talk about strategic value creation, and this is a vast topic. And I have 5 slides, but the 5 slides may, we can spend 5 hours if you want. So let me at least begin, and I'm going to time myself to make sure that I stop at a reasonable time so that some of you get a chance to ask some questions, and then we hope to keep this interactive. So the first slide that I often start this conversation with are a series of questions. So I'm a very big believer in understanding the business model of the firm. And it turns out that these questions, by the way, come from Sequoia. Sequoia, the venture capitalist. And the reason I share that with you is to tell you that the questions, I'm sorry, that you need to ask, regardless of who you are, for value creation are always the same. So it doesn't matter if you're a VC, it doesn't matter if you're some other kind of owner, a supplier, a customer that is interested in the company, maybe an acquisition target, or whatever. Because ultimately, the conversation is about financial sustainability, meaning, will this enterprise create repeatable earnings or cash flows or whatever your favorite flow term might be, because that's what gets a multiple. So let's kind of break this down. So we start with, what is the entity's purpose? Why does it exist? And how does it plan to create value? The next set of questions deal with the revenue side of the income statement, if you will, arguably the most important number. Without revenue, there is nothing. So the questions we are trying to ask here, who are your customers and what kind of problem of theirs are you trying to solve? What is your solution and why does it work? And here we are talking about barriers to imitation, because all of us know Amazon's strategy. We just don't have the resources to imitate Amazon's strategy. So it's not as much information, because we all know the strategy. It's barriers to imitation. What will stop somebody from copying me? How big is my serviceable obtainable market? So if you're thinking of, say, Tesla, which is trading at whatever it's trading at, like $1 trillion, and as you know, Tesla's market cap is probably bigger than the rest of the 7, 8, 9 massive car companies combined. So how is Tesla ever going to grow into this market cap via cash flows? Maybe it's not. So that's the point I'm trying to make here. So how does management explain its serviceable obtainable market? Now, of course, there's always some wishful thinking and some spin. we'll have the Hyperloop or we'll go to Mars or fine. All that is great. Energy storage stack for Tesla. But it's nice to see some kind of business model. How exactly are we going to make money on these things? How big is our market? Why should somebody buy from us and not from someone else? Which kind of brings me to the next point. What's the competition like? Is super important because we are all optimistic about what we do as entrepreneurs, but it's also you know, very important to keep an eye on who's competing with us. And sometimes the firms that are competing with us are not even obvious. Maybe it's somebody sitting in some garage. History is replete with examples of firms that knew that a technology is going to come and make them obsolete. Now think about IBM, think about Blockbuster, which apparently had a chance to buy Netflix not once but three times. Think about IBM again in the context of, say, cloud computing. Amazon and Microsoft just went way ahead. AI, I mean, IBM had Watson way before many of the others, before AI was even a thing. And somehow they've had a tough time monetizing that. So the competition may not be the obvious competition. It may be emerging competition. And Intel is another example. Andy Grove, one of the famous, probably co-founder of Intel, used to make the statement that only the paranoid survive. And Intel itself seems to have forgotten that message. As you know, they've struggled a lot with earlier with mobile computing, and now, of course, with NVIDIA and the GPU market, and Intel is in deep financial distress. So the competition point is an important one to think about. It's not just current competition; it's what's coming down the pike, and it may be a company that you don't even know about. You know. The next point, how is revenue being generated? And I'm usually a big fan of breaking this up into elementary econ 101. How much is quantity, how much is price, and how much is currency? And the reason I like that, and very few companies do this, by the way, is that in a globalized world, it's very difficult to keep growing by raising prices. Unless you're some kind of, special oligopolist like a Google, which probably controls something like 40% of the advertising market. Uh, Currency, I mean, if you're doing well because the currency has worked in your favor, you should stop selling toothpaste or GPUs, and you should go to an investment bank and try to make money on currency, because it's very hard to keep that going. It's mostly just luck. I mean, you can have some strategic decisions that probably make you money on currency, but that's hard to do in general. So the big point here being, the only real sustainable advantage probably comes through volume or quantity. And I'll give you an example of, say, Apple. Apple sold a lot of these devices, wearables, and of course the iPhone. And virtually overnight, maybe in like 3, 4 years, they were able to build something like a 40, 50, now $75 billion services business. So volume is probably the only way to really sustain uh, in terms of the future. That could be habit formation. That could be perhaps selling add-on services like what Apple did. And then, of course, you need to worry about distribution. How does the product actually reach the customer? Tesla's example here is again interesting because, as you know, in the US, for car companies, you end up selling cars through dealers, and dealers add 300-400%, basis points to the cost of the car, which can be very expensive. So Tesla, rallied against that, started, why can't you just sell cars on the internet or something? And that gave them a fair amount of competitive advantage, meaning 400 basis points better than probably a GM or a Ford. So the distribution network matters. Sometimes you can make a lot of money through distribution too. So for instance, General Motors, um, their subprime business was actually super profitable. They made a lot of money by just lending people money to buy cars. And it turns out that the default rates for subprime cars was actually much lower than that for subprime homes. And it turns out that people have to, at least in the US, if you don't have a car, you don't end up going to work, and that's terrible. You can even lose your home, you can sleep in your car, but not having a car will hurt you. So people would pay the loans on subprime cars. So that's another example of where the distribution network could be a fairly impressive source of value creation. But what's ironical here is that when the Feds bailed out GM, they actually, I think, forced GM to sell its subprime business because they didn't quite understand how much value it creates. So that's an example of how the distribution network is quite important and can be a huge source of value creation for the firm. Next, we talk about people, you know, very important. And I have just one line devoted to it, but doesn't mean it's not important. It's arguably the most important thing. You know, in at least in the US, by and large, we are not making things, and that's the, as you know, the source of a lot of political hand wringing in Washington and other places. All we have are effectively people. The most of the manufacturing is probably being outsourced. Uh, in my view, companies don't do a very good job. Not all of them do a good job managing talent. And I often joke, if you're running a hedge fund and you keep selling securities that go up in price later, somebody will fire you eventually because you're a terrible trader. But this thing happens all the time with HR. We have people who leave and get raises elsewhere, and somehow we never manage to keep them happy. Maybe appraisal processes don't really work the way they should, but nobody uses the securities logic with HR. Why did so many people leave? How come they got raises later? Is anybody tracking what happens to the people who leave? Are people inside happy? Is there a succession plan? What does turnover look like? Do we train people? Do they come to work because they feel like coming to work, or do they show up because they're forced to? This kind of has implications for the return to work thing that you're probably seeing as well. So I can't emphasize how important people is. What else? You can also then look at maybe the materials costs if you are a manufacturer of some kind, or other kinds of costs. And here I emphasize the distinction between fixed and variable costs. Again, this is Econ 101. It's not difficult, but looking at a financial statement, it is actually very difficult to know what are the company's fixed costs and the variable costs. Um, so, for example, technology, the whole play is about fixed costs, right? If you're a Netflix or something, you're spending a lot of money on content, but the incremental cost of delivering the movie or the show to the customer, you pay a little bit to AWS, it's virtually zero. So the whole tech play is about spending a lot of money on fixed costs and then trying to recoup some of that fixed cost through contribution margin, which is technical speak for the sales price minus variable cost. But it's very hard to get a sense for that unless you know the business well and try to think hard about the costs. Finally, we can talk about capital structure. The other way to make money is lever up. Debt is cheap, interest on debt is tax deductible. But of course, we rarely see entities in the world with 100% debt. So why is that? What's the optimal trade-off between equity and debt? You also need to worry about off-balance sheet debt. How is the incremental capital allocated by the firm? This is again hard to really know because at best from the outside you'll see capex, or it's even harder to know with intangibles like R&D and SG&A. So discipline around how capital gets allocated is arguably one of the least discussed and most important things. In general, what do you do with your cash flow? Should you buy back? Should you pay dividends? Should you pay a special dividend? Should you invest in capex? Then you have to talk about maintenance capex, which I often complain about, because think about maintenance capex as the bare minimum capex that you need to spend to simply stay where you are in terms of product position or market share. And that is ignored so many times, and it becomes even more complicated when you think about, say, the maintenance component of intangibles, like how much R&D is necessary for us to just stay where we are, how much SG&A is necessary just for us to stay where we are. So arguably, you can say when Facebook bought Instagram, it was arguably maintenance capex, but the accounting system just capitalizes the whole thing and shows this as capex as an asset. So that's another flawed piece of reasoning and thinking that needs to be discussed when we talk about capital allocation. And last but not the least, companies are rarely run by owner managers. Perhaps it's no accident that so many of our large trillion-dollar companies these days are either run by owner managers, like say Nvidia by Jensen Huang, and maybe Musk with Tesla, Bezos still recently for Amazon, and so on. But if you have a professional running the firm, then you have to figure out a way to pay this person. And I often joke, I mean, compensation plans are like, exams that you write for students. People will find some clever way to say this is, they'll try to maximize their points without necessarily demonstrating knowledge of the material. So that's basically what exec comp arguably becomes. And it's even more complicated in today's world, especially for large US companies, because 25% of the stock is effectively owned by BlackRock, Vanguard, State Street. Arguably, as I sometimes joke, your biggest investor in these companies is a computer program. So they're arguably disengaged owners. So who's keeping an eye on how management is paid? What is the strategy? Is there some hope that the comp plan has some way of at least getting us close to the strategy? So these are the questions one can discuss about how is management doing? What should the metrics be? Should we be looking at long-term metrics, short-term, non-financial, financial? What should the balance be? How should they be paid? It's a huge area which potentially is interesting because how you pay people does make a difference to what they do. Finally, risks and opportunities. Something that we haven't thought about in general. Maybe the 10K risk factors. People often don't read that, thinking that it's boilerplate, but I think it's very insightful. You should read it at least once. And last but not the least, I mean, we are Columbia Business School, so we are the school of value investing. So we don't believe price necessarily reflects value at all times. So, what might our rough sense for the intrinsic value of the entity be, and how does that compare with price? So let me stop there. I have a few more slides, and I'm already like 4.5, 5 minutes over my canned portion of the presentation. But the big takeaway for you is, take these questions and try to apply this to your business or whatever investment you're looking at. And if you're not able to provide reasonable answers to these questions, chances are, I mean, you've identified a blind spot, and it's a place that you dig more, try to understand more. Uh, so I just wanted to at least share these questions with you as a starting point. And let me just stop, Lindsay. Maybe I should bring you back in case there are questions, and I haven't been monitoring the chat. Maybe you can help.
That's okay. No, yeah, we do have a lot of questions coming in, Shiva. People from all over the world are joining us today. I saw Mexico, I
This
saw
is
Pakistan.
incredible. Yeah. I'm sitting in London. I was just joking to Lindsay that it's bleak and dark here. So we've done the best we can with the lighting.
Yeah.
But it's heartening to see this much interest. So thank you, everyone.
Yes. Thank you everyone for joining. So we're going to get into some of the questions, um, both that are live in the chat and some that were pre-submitted before the webinar. The first one I want to kick off with, Shiva, is from Nicola. And she says, what's the biggest value driver most leaders overlook?
I would say human capital. I think I touched on this earlier because we tend to undervalue the people we have. Most people, I mean, of course there are bad people, but most of them are, as long as your interview process works reasonably well, are well-meaning. Are we giving them the right jobs? Are we, as I said, do they come to work because they feel like coming to work or because they have to for a paycheck? That makes a big difference. So I'd go back to human capital. And again, most companies say that human capital is their biggest asset, but a lot of it is cheap talk. I mean, do they really mean what they say? Right. So.
Nora says, how do you create strategic value creation for small organizations?
Small or large, I think the answer is always the same. It is a maniacal focus on the customer. I often refer people to the Amazon leadership principles, and maybe I'll find it. I had it pulled up here, and I'll leave this in the chat. It's actually incredible. And can I share my screen, because I think it's kind of lots of
Absolutely.
learning. Let's see here. How do I? Should I just post this on? Maybe I'll just post this on hosts and panelists, and maybe you guys can pass it on, because in the interest of time. So let me just share I mean, there are lots of leadership principles, but they're actually fantastic in general. So can you see this, Lindsay? So this is from the
Yes, I see your screen.
yeah, you can see a lot of other stuff I'm doing here as well, which is okay. Nothing crazy. Customer obsession, the number one point, over and over again. Think like an owner. Again, fantastic. Leaders are owners. Think long term. Don't sacrifice long term for short term. Never say this is not my job. Invent and simplify. This is another problem with engineering run companies. They invent and complicate. Apple is fantastic at this. Just invent and simplify. And the idea that if it's not invented here, it's somehow uninteresting. I can go on and on. Leaders are right a lot. They don't have to be right every single time. Learn and be curious. These are all, eternally interesting principles for us to keep in mind when we hire people. Hire and develop the best. Insist on the highest standards. Think big. Bias for action. Speed matters. It's I've come across many people who are fantastic at great thoughts but can't do anything to save their lives, right? So they won't get hired at Amazon. Frugality, again, interesting. Earn trust. Dive deep. Yeah, superficial stuff is not interesting. Have backbone, disagree, and commit. I think this is fantastic. You should dissent if you don't agree, but once a decision has been taken, you have to move on and support the enterprise, even if you don't agree with what was decided. Deliver results, strive to be the earth's best, and so on. This is that I think 21 odd principles, but this gives you a flavor for what people might want to shoot for.
Very nice. Yeah, I dropped that link in the chat for anyone who wants to take a look at it after in more detail. So thank you for that, Shiva. Going on to the next question, Amy says, how should someone balance short-term profit pressure versus long-term value creation?
Well, the easy thing to say is never underfund the long term. This is like Amazon, but a lot depends on culture. So if you have the right culture, and again, maybe Bezos was exceptional, but he basically said, don't ask me about profits for like 20 years. Now I know everybody can't afford to do that. A counter example is a company like 3M, Minnesota Mining Manufacturing. They have three slots for short term, mid term, and long term. And their claim is that the reason we want to do well at all three is because we don't want to think there is a trade-off. So if you don't do well in the short term, then analysts are going to come after you, et cetera, et cetera. Your investor relations group is going to have a huge problem dealing with that. If you don't do well in the middle term, then the stock will fall in general. And unless you invest for the long term in terms of moonshots, meaning things that may or may not pan out, but if you don't take any risk, then you won't have a business anymore because somebody smaller, nimbler is going to kill you, right? So one role model might be somebody like 3M, where you argue that maybe there's not, at least I don't want to recognize there is a trade-off because you want to do well. You just compartmentalize your world in maybe projects that hit in the short versus medium versus long. The other, if you have a leader or a culture that will actually support long-term thinking, and if you can bring your capital providers with you and sell the vision correctly, then maybe that's the other way, the Amazon way.
Very insightful. Thanks, Shiva. James says, how do you know when to pause or to stop during a heavy growth investment?
So I often tell people, it takes 5 years for anything to actually pan out. So the bigger worry tends to be people get interested in something new and then they go in and then they start expecting results almost too soon and then they underfund the investment. As a result, it never takes off. And then they say, look, I told you it's not going to take off. So that's a self-fulfilling mess. You don't want that. So at least give it 3 or 5 years before you decide. And then, if things are not looking good, then you pull the plug, stop committing more capital to this. But maybe 3 or 5 in my mind is a reasonable trade-off between short and very long. If this is going to pan out only in 30 years, I get very nervous about those things. And you can say the same thing for acquisitions as well. If it's not going to pay off in 5 years, maybe a lot of this is just smoke and mirrors.
Great. And Jose actually wrote something in the chat, so maybe we can address this. He said, in order to create value for the shareholders, first you have to create value for their stakeholders, right?
Yeah, this is a classic problem, not a problem, but yeah, I mean, they need not be trade-offs. I mean, it's again complicated. In some cases, they are. I often talk about Costco as an example. Costco, I mean, all of us, by and large, I'm guessing, if you're US based, love Costco. They're very good to customers. They're also very good to employees, by the way. But by definition, they cannot be very good to suppliers because the money is coming out of the suppliers' pockets. So it is very hard to be good to all stakeholders unless you're Google or something and you have money pouring out of every orifice or something. So unless you're that rich, it is pretty difficult to be good to all stakeholders. I mean, there are trade-offs. I've often said perhaps you want to maybe focus and limit and declare the 2 or 3 stakeholders that you actually care about. And Costco does this. They'll say we care about customers, we care about employees, and we respect our suppliers. So it's hard to be good to everybody unless you're making too much money.
Mm-hmm. Good example. We actually had another question come in the chat too about someone says, I'm curious for your comments on whether, as a practical matter, boards are actually useful to a company. And I have to ask you that, Shiva, because I think I know the answer, but I'd love to hear your thoughts on that.
This is somebody who's probably taken one of my classes. He's setting us up. I often, challenge people when I do the governance thing. I must be the only class in the educational sphere where I ask people, what would happen if boards shut down? How much value do they add? It's a really difficult problem to think about. It's an opaque institution. It does self-evaluations. In theory, owners are supposed to appoint directors. In practice, that sometimes does not happen because, as I said, if you're a large S&P 500, even a 1500 company, the big three investors are BlackRock, Vanguard, State Street. They don't really have the right to appoint directors in the US, unlike, say, Sweden. In a Sweden, if you own 5% of the stock or more, you can nominate directors. So the governance process in the US, I think, is quite messed up, contrary to the usual Pollyanna-ish thinking that we are somehow the best in the world. So I think boards have to work very hard to earn the trust of stakeholders. Not all boards are bad, but a lot of them are disengaged. There are all kinds of issues. Maybe they're not paid enough, although the numbers look big. There are usually 6 meetings, 3 days, 18 days, and let's say 10, 11 hours of commitment. If you're board worthy, your compensation is at least $1,000 an hour. So that's basically what these people get paid, like $200,000. So you're effectively paying people simply to travel. Where is the time to work, think? And it's a peculiar job because board members don't have staff. They don't have consulting budgets. So several issues to be thought about, with boards.
Thank you for your comments there. And for anyone who's curious, Shiva teaches a corporate governance developing exceptional board leaders program as well. The next question, Shiva, I know we have a couple minutes left here. What's one leadership move that is the biggest payoff for value?
I'm going to, sound like a broken record and say the same thing over and over again. In general, focus on the customer. And when in doubt, think like an owner. That's why, I shared a little bit of Amazon's leadership principles. So go through that list, think about, what makes sense to you, what resonates, but it's always about the customer, right? Because Amazon's a great example. I probably go back to them over and over again, but I think it's such an amazing case study.
Great, thank you.
Obsess about the customer. Maybe that's one principle.
Wonderful. And the last question I think that we have time for is from AJ, who says, what's the secret to creating competitive value that can be sustained?
Same answer. Worry about the customer. Remember that whole conversation about revenue that we discussed? Who are your customers? Why are they buying your product? Why can't somebody imitate you? How are you actually selling? Is the growth through price or quantity or currency? How big is your serviceable obtainable market? What does your distribution channel look like? So those are at least 4 or 5 questions that you should be able to convincingly answer. If not, if somebody doesn't buy your product, a lot of the other stuff is internal facing. You can still kind of do something about inputs, maybe, in terms of how you make it and the people you hire and your costs. But the external market has to support you. That's where everything starts.
Great. And since we do have 1 more minute left, I just want to take this last question from Robin, who says, it seems to me that a lot of businesses begin to fail when they confuse solving their business problems with solving consumer problems, and they can't do the former unless they're doing the latter. Would you agree?
What's the distinction in this person's mind? What's the distinction between a business problem and a consumer problem? Sorry, maybe I need a little bit more.
Seems to me a lot of businesses begin to fail when they confuse solving their business problem with solving consumer problem. They can't do the former without doing the latter. They didn't specify. Maybe.
Yeah. Well, I'm just going to interpret the question the way I think it was written. But there are companies like that. There are companies that put out an excellent product, but they are never able to break even. Or so they generate. I mean, this happens a lot during the early VC funded, time of a product, and then they suddenly disappear. So yes, you could overdo what I said, obsess about the customer. If you give a product away for free, of course, people are going to love your product. Doesn't mean anything, right? So there are hundreds of examples of such businesses. Maybe that's what this person's saying. So being customer obsessed is fine, but if you're not making enough, even to survive or break even in the long run, ultimately the VC funding is obviously going to disappear, and then you won't have a business. Maybe you'll make a good acquisitions target. Somebody will buy you. They can handle. They can cut your costs because of scale, or maybe you end up becoming a target for private equity.
Great. Thank you so much, Shiva, for joining us today, and for your presentation. For everyone on the call, thank you. We're looking forward to your upcoming sessions, Shiva, a strategic value creation transform strategy into sustainable advantage. That program is taking place in November the 18th to the 20th in person in New York City with Shiva. If you're interested in joining us, be on the lookout for more information about this program in your email. And on behalf of Columbia Business School Executive Education, thank you so much for joining us and have a great day.
And thank you to the 200 plus people who tuned in. It means a lot to us. As educators, we want to reach people. So thank you.
Absolutely. Thank you. Take
Thank
care.
you, Lindsay. Take care.